Opendoor Technologies, ticker symbol OPE, is currently trading live at $8.49 per share, experiencing a sharp downturn of 0.80, which translates to a significant 8.61% drop for the day. Now, when a stock in a beaten-down sector like real estate takes a hit like this, the immediate reaction, the expectation, is pure capitulation. The narrative writes itself. Rising interest rates are a death sentence, the housing market is frozen solid, and the iBuying model is fundamentally broken. But that's the surface-level story, the one that causes panic selling on platforms like the Robinhood app. The reality of what's happening under the hood with Opendoor is far more complex and, frankly, far more interesting. The intense selling pressure we're witnessing today isn't just a simple reaction to market sentiment. It's a reflection of a deep-seated battle over the future of real estate transactions, and today's price action is a critical data point in that larger conflict. The prevailing belief among many market participants is that Opendoor is a glorified house flipper dangerously exposed to macroeconomic headwinds it cannot control. They see the Federal Reserve's rate policy and assume Opendoor's balance sheet is a ticking time bomb of depreciating assets. This is the common ground, the shared understanding that has driven the stock down from its former highs. However, this perspective fundamentally mischaracterizes the company. It's not just about flipping homes, it's about being a technology-driven market maker for the single largest asset class in the world, residential real estate. The company's core value proposition is liquidity and certainty in an industry infamous for its lack of both. The challenge to the common belief is this: what if this brutal housing market correction is the very fire that forges Opendoor into a leaner, smarter, and ultimately more dominant company? What if the market is fixated on the cyclical downturn while ignoring the structural efficiencies Opendoor is building? This isn't a simple bet on housing prices going up. It's a wager that their technology and data platform can fundamentally change how homes are bought and sold, regardless of the cycle. Let's dissect today's 8.61% decline. Trading volume has been notably higher than its daily average, suggesting conviction behind the selling. This isn't just passive portfolio rebalancing you might see in Fidelity ETFs. This is active, aggressive selling. Part of this is undoubtedly linked to broader market fears. When you see high-growth tech names like Tesla stock or Nvidia stock facing pressure, capital tends to flee from higher-risk assets across the board, and Opendoor is certainly perceived as high-risk. But there's also a sector-specific component. Recent housing start numbers or mortgage application data may have come in weaker than anticipated, triggering algorithmic sells across all housing-related stocks. Traders using sophisticated tools on platforms like Interactive Brokers would have their systems programmed to react instantly to such data, creating a cascade effect. For the average person engaging in self-investing, this kind of volatility can be unnerving, but it's crucial to look past the headline number and examine the institutional flows. Recent 13F filings show a divided picture. While some growth-oriented funds have been trimming their positions, several value-focused institutional investors have been quietly accumulating shares on these dips. They aren't looking at the next quarter, they're looking at the next decade. This is the kind of long-term perspective often advised by services like Schwab Intelligent Portfolios, which prioritize strategic allocation over chasing short-term market noise. Looking back at their last earnings report, the numbers were, on the surface, challenging. They reported significant write-downs on their existing inventory of homes, which they had acquired when prices were higher. This was expected, and the market punished them for it. However, the more important metric to watch was their contribution margin on newly acquired cohorts of homes. Management was adamant on their conference call that the homes they are buying today are being acquired at much more disciplined, conservative valuations. They have tightened their buy box significantly. This is the key reality that contrasts with the market's expectation of continued uncontrolled losses. They are actively adjusting their algorithm and their purchasing criteria to reflect the new market environment. This demonstrates a capacity to learn and adapt that a simple house flipper lacks. For anyone using Fidelity Investments for an individual brokerage account, understanding the nuance between headline losses on old inventory versus the profitability of new inventory is the difference between a panicked sell and a calculated investment decision. So what does Opendoor actually do? At its core, it's an iBuyer. A homeowner can go to Opendoor's website, enter their address, and within a day receive a preliminary all-cash offer for their home. If they accept, Opendoor conducts an assessment, finalizes the offer, and can close the sale in a matter of days. This bypasses the traditional, often lengthy and stressful process of listing with an agent, staging the home, holding open houses, and negotiating with buyers. Opendoor makes its revenue in two primary ways. First, from a service fee, which is typically around 5%, comparable to a traditional agent's commission. Second, they aim to make a small profit on the resale of the home after making light repairs. Their entire business model hinges on the accuracy of their pricing algorithms. They use vast amounts of data to predict a home's future sales price, allowing them to make a confident cash offer. This is where the technology component is so critical. It's not just about real estate, it's about data science. The ease of access to trading platforms, from the Fidelity mobile app to SoFi Investing, allows anyone to take a position. But a deep understanding of this business model is essential for any form of online investing in the company. Looking ahead, the path for Opendoor is fraught with both immense risks and significant opportunities. The most immediate risk is the housing market itself. If home prices continue to fall precipitously and faster than their models predict, they could face further substantial write-downs. The cost of capital is another major headwind. The credit facilities they use to purchase homes become more expensive as interest rates rise, squeezing their margins. This is a real, tangible threat that cannot be understated. Furthermore, competition, while currently diminished, could reemerge if the market turns. These are the bearish realities that support today's negative price action. However, the catalysts for a potential turnaround are just as compelling. The single biggest catalyst would be a signal from the Federal Reserve that its rate hiking cycle is over. The moment the market snicks out a pivot to a more dovish policy, interest rate-sensitive sectors like housing will likely see a massive inflow of capital. Opendoor, with its high beta, would likely be a major beneficiary of such a sentiment shift. Another significant opportunity is market share consolidation. The current downturn is shaking out smaller, less capitalized competitors. If Opendoor can successfully navigate this period, they could emerge on the other side with a much stronger competitive position in the iBuying space. Their ability to refine their pricing algorithms during the most challenging housing market in over a decade could become their greatest long-term asset. This is the ultimate test of their model. Given the current state of the housing market, do you think the iBuying model has a long-term future? Comment your thoughts below. The bull case scenario sees Opendoor emerging from this downturn as the undisputed leader in a transformed real estate industry, much like Amazon used the dot-com bust to solidify its dominance in e-commerce. Investors using a SoFi active investing account might see the current price as an attractive entry point for a high-risk, high-reward position. In the end, the story of Opendoor is a classic case of expectation versus reality. The market's expectation is that of a company doomed by the macroeconomic environment, a casualty of the end of cheap capital. The stock price today certainly reflects that bleak outlook. But the deeper reality is that of a technology-focused disruptor being stress-tested in real time. The company's survival and future success depend not on the direction of home prices next quarter, but on the enduring strength of its value proposition, providing speed, certainty, and simplicity to the archaic process of selling a home. The pain they are enduring now, the losses on inventory, the public market scrutiny, are all part of a process of hardening their model. The ultimate outcome is far from certain, but to dismiss it as just another failed housing venture is to ignore the fundamental technological and logistical platform they have built. The current price reflects the fear, but it may be failing to properly account for the resilience and long-term potential of a business built to bring modern data science to an industry desperately in need of it. Disclaimer: this video is only for educational purposes and not financial advice. Do your own research, DYOR, before investing or donating. Call to action: like, love, comment, share.